Parker of Credit Suisse Asset Management joins in now. Robert, morning. Thanks for joining in. Of course, it was all sparked off by Citi when Vikram Pandit came in and said Citi made profits in the first couple of months of the year. How much of a positive would you take away from that statement for the overall financial space in the US?
I think one of the key factors in global equity markets on a medium-term view is the state of the banking system. And obviously, if we look back over the last 3 months, the last year, the financial services sector has been the worst performing sector globally in equity markets, with particular stress being seen in the share prices of organisations, not just Citigroup, but here in the UK, I would also highlight the share prices of Royal Bank of Scotland and obviously Lloyds Bank Group. I think one of the key fear factors that investors are very worried about is what further write-offs are we going to have? And if we look back over the last 18 months, bank write-offs worldwide now exceed $850 billion US dollars. My view is that we're seeing, with respect to Citigroup, a major restructuring coming to a head. Citigroup are selling off non-core assets. For example, they've done a partnership with Morgan Stanley on their Smith Barney brokerage business. They're selling off Nikko Cordial Securities in Japan. So this selling off of non-core assets, this raising of capital, whether it be from sovereign wealth funds or the US Treasury, plus the write-downs of underperforming assets, I would argue that we are not necessarily in the final stages of this restructuring of Citigroup, but we're certainly close to the end game. The share price recently has been less than $1. You could almost say that share price is now a call option rather than a real share price. Clearly, unless you think there is going to be nationalization of Citigroup, which the American government has said they're not going to do, unless you think that there is going to be a further massive write-down of toxic assets, the downside risk in the equity now is very limited. And it's interesting how, in the last few days, how the share price has been insensitive to bad news and sensitive to good news, and we saw that particularly with the jump in the shares in trading yesterday.
Robert, morning. The first part of March, though, has been quite vicious in terms of a price cut for equity markets. What are the chances that markets might rebound a little bit or play basically for a bear market rally now?
I think there's a very high probability that we will have what I would call a bear market rally over the balance of March and going into April. However, I don't think that's going to be a sustainable rally. And I do think there's a risk that actually markets could have another setback as we go into late April and early May, particularly when investors start to focus on the announcement of corporate earnings results for the first quarter. And clearly there's going to be a lot of negative news coming out in markets in late April, early May. So as a result, I think a trading rally is likely, but don't assume that this is going to be a sustained rally.
What about emerging markets, Robert, then? I mean, do you expect EM equities to also pick up any kind of a bear market rally that you're seeing in the US?
I think you've got a very interesting situation in emerging markets because in the fourth quarter of last year, and particularly following the bankruptcy of Lehman Brothers, investors worldwide reduced risk significantly. They sold assets in overseas markets and returned to their home markets. You saw that particularly with American and Japanese investors. And Japanese investors had been big buyers of emerging market funds, and particularly BRIC funds. Likewise, American mutual funds had invested heavily in emerging markets. So you saw this risk reduction and this flow of capital indiscriminately, irrespective of whether an emerging market was being managed well or not. There was this wholesale sell-off with capital going back into home markets. I think what has been another negative factor is that we have to divide emerging markets today into those that are performing well with respect to their economic performance and those where there is clear economic stress. In Latin America, we've had quite serious economic stress in a number of countries, notably Ecuador defaulting last December. In Central and Eastern Europe, there is severe economic stress, notably the Ukraine, Latvia and Hungary having to go through IMF restructuring programs. And investors have not actually discriminated between those emerging economies which are under pressure and those which are well managed, and therefore it's been a wholesale sell-off. But we've had this, obviously, this flow of bad news over the last 6 months of those emerging economies where you have big current account deficits and a big reliance on foreign financing.
For yourself then, Robert, tactically at this point, how would you position yourself on India as a market?
We have done in emerging markets over the past year has been to reduce risk and be very cautious. What we did in December and January is that we have gone back into the Chinese market largely because of how impressed we were with the size of the Chinese fiscal stimulus. We have gone back into the Brazilian market as a play on commodity prices forming a base and eventually recovering. We have not yet gone back into the Indian market. One thing that we are watching very carefully indeed is actually the valuation ratio of India versus China. The fact that we have not gone back into India is not a negative statement on the Indian economy. It's just that we felt that China and to a lesser extent Brazil would actually lead equity market performance in emerging markets. We're watching very carefully at the moment that valuation ratio between China and India. My expectation is that come the second quarter, and possibly the middle of the second quarter, we will be in a situation where the Chinese rally means that China becomes expensive to India, and therefore we will want to refocus again on the Indian market.
For the moment, though, Robert, would you expect India to be in a bit of a trading range till this China becoming more expensive relative to India plays out in your eyes?
You say India's been range-bound. If you look at emerging markets and the key emerging markets since the beginning of this year, Russia since the beginning of this year is up very marginally. It's recovered strongly in the last 2 weeks. China year to date is up about 18%. Brazil year to date is up about 3%. Obviously India is down and down quite sharply year to date. So we've had this quite sharp underperformance by the Indian market. I'm not that concerned about the macroeconomic outlook in the Indian market, and I do think we're going to have a very interesting situation probably in the second quarter whereby India is cheap relative to those other major emerging markets, and therefore you'll see a rebound in India relative to the others.
Robert Parker, appreciate you taking out the time for us today. Good speaking with you. That's the Credit Suisse view on the market, which, by the way, is absolutely flat now, just holding 2600. More